So what's the first thing that comes to mind with financial regulations for you guys? SEC. Okay, yeah, so we've been talking about stocks and stuff. Other like specific types of regulations that the government has on the books that come to mind related to the banking or financial sector? How about with banking? If you put your money in a bank,
FDIC.
what do you have? Yeah, the FDIC. So what does that stand for? Alright, my fingers crossed that I didn't just break that sucker. So FDIC, Federal Deposit Insurance. All right. So, so why did we get that? So let's kind of backtrack a little bit to even money in banking. So we had these banking panics and the need for deposit insurance. I think what I want to do is change that word for need to, how about desire for some sort of insurance or assurances. So somebody run down what the bank panic was all about. Bank panic or bank run. Isaac?
Wasn't it where a whole bunch of people, or a couple people started thinking like, oh, I need to pull my money out of the bank, and then word keeps spread around, and then everybody runs to the bank run to get their money out of the bank, but the bank doesn't have everybody's money.
Yep.
You know, Johnny has $10 here, Luann has $10 here.
Good, yeah, so that is the quintessential bank run or bank panic. So we call that a contagion effect, which we'll also see in financial markets globally, a contagion effect, like being contagious with COVID or the cold. I guess that takes on a whole new meaning nowadays. But the contagion effect is one person's panicking, and then that leads to another person panicking and another person panicking. So that kind of behavior is called a contagion effect. So, so the FDIC short circuits bank failures. Bank failures and contagion effects. And so it short circuits it in a couple different ways. One is people know that they're covered already, so even if they hear of somebody panicking and pulling their money out, they're like, who cares? I got the FDIC insurance anyway, so I'm not going to do it. So that's one way that it short circuits it, and so that helps with that spreading. So so people know they are covered and don't care if rumors spread. What's that? Yes, it is up to a certain amount. Does anybody know that certain amount? 250,000. It got raised during the financial crisis. So, what's that?
I said 350.
Unless I'm thinking of the old number, I don't look at that much, but let me see here.
That's what I thought you said.
Yeah, I think it's 250. I think it used to be 200, yeah. Yeah, 250,000. It used to be 200, I think, before the financial crisis. And maybe it was even lower than that. I don't know. It's a long time since I did that, but they did raise it at some point in time. I think it was around the financial crisis. So we've got deposits less than or equal to $250,000. And it's not just deposits, it's deposit accounts by one person if we want to be specific. Deposit accounts by one person. So in other words, if you have a checking account and it's got 200,000, and you got a savings account that has another 200,000, that's $400,000 at one bank, you're only covered up to 250,000. Now, if you have 200,000 at Wells Fargo and $200,000 at Bank of Midwest, then both of those accounts are covered. So it's at one institution, you're up to this 250 in total, right?
If you're married and have like a joint savings and pension, is it still 250,000 for that one?
It's still 250,000. So what they're trying to do, what the feds are trying to do is not have any one person or one household or one family be too much. Well, let me take that back a second. If I have my own personal account there, and my wife has her own personal account there, and I'm not a signer on her account, then that doesn't matter. Both are covered up to the limit. But if we have the joint account or whatever, then we've got this 250. And so all the Fed, what's the Fed trying to do? Why would they design it that way? At any one institution, we're trying to limit one person having, potentially 250, or it's just their own risk.
So the bank doesn't just run dry.
Yeah, so that there's not too much at one particular place, so that if the bank is having trouble, then they're kind of dependent on one particular rich person that has $10 million in an account or something, right? So that way it kind of forces them, if they want to be covered by FDIC, to spread their accounts over multiple banks. And then that kind of is a diversification tool in a sense for the federal government. Okay, so then we've got two different ways if a bank fails. So if a failure occurs, or it kind of occurs or starts to occur, we have the FDIC can do a payoff method. Which is to just liquidate. It helps the bank liquidate, which is kind of like going through bankruptcy, basically. So they're going to liquidate all their assets in kind of an orderly way, and then if there's anything left over for the shareholders, of course, the FDIC is going to make sure that the depositors get the bulk of the assets paid for. And if they end up getting 90 cents on the dollar or 80 cents on the dollar or something, and they have to take a bit of a haircut, then the FDIC is going to cover any deficiency on individual accounts. So that's called the payoff method, which is kind of like bankruptcy. Of course, the next one's like bankruptcy too. I should say chapters, businesses. It's like chapter 13 for personal life. All right, so then the other method is the purchase and assumption method. Purchase and assumption method. This is typically more costly for the FDIC to do this method. Usually more costly to FDIC. So they don't do it as much. And so it's just like it sounds. The FDIC is going to take control of the bank, basically buying it in a sense, and then assume control and try to do things a little more. Maybe they would do this method if the bank is just like really close to being solvent, but not quite there. Rather than just doing the payoff method and liquidate everything and fire sale, maybe they can milk it out. But of course, the longer that goes on, the more risk, the more, that might not pan out. So that is the two ways that the FDIC fits in. All right, so any questions or comments there? All right, so other safety nets. Other safety net of government is the lender of last resort that we learned about in the central bank. So the Fed acting as lender of last resort. So the Federal Reserve can come in and give a loan to the bank. Now with that method, the bank's not being taken over. So this is much more serious if we get to the FDIC and we're looking to liquidate or have this purchase and assumption. This is where the bank's just real close, maybe being fined, and they'll work things out if they change some of their business practices or whatever. So the Fed will give a loan out to them, and with all likelihood that that loan will be paid back. Those are generally short-term loans. So this is generally short-term, definitely less than a year, and hopefully they can do well. If they start to not do well, then they'll probably take action to take them over. Okay, so let me do a little example with the liquidation stuff. So if a depositor typically gets 90 cents on the dollar, 90 cents on the dollar for the haircut, on the dollar on average. How much does, how much is covered with a $350,000 deposit? Okay, so now I'm talking about somebody who has $350,000, because people do go over the $250,000 limit. They're just like, oh, this bank's fine. I'm not that worried about it. I'm not gonna, be right at the max. So they've got $350,000, and so how much is this depositor going to get back? 250.
So you got 115,000, or they're insuring 115, right?
I'm not sure I've heard the right answer yet. 300 and what?
40,000.
40,000. How'd you get that, Bryce? Sounds right.
250 is back by the FDIC, and then you just take the 6% haircut off the
Yeah. All right. So you got 350 total. So you got 250,000. That is 100% covered. And then you've got 100,000. That is 90% expected. Let's just put it that way, expected. And so we add those two together and we get $340,000 is the expected amount depositor gets with the bank failure. All right, everybody with me on that math? All right, here's the problem. If they end up going through the process and you've got the rest of the creditors, it could be 2 years before you get this money back. So that's kind of the kicker. That's a bit of a bummer, which you want to be careful that your bank is actually doing good. So here's the note. It may be 2 years before you get the extra 90 as the bankruptcy liquidation process goes through. As the liquidation considers all claims to the assets. So this part here might be a little bit of a wait. Okay, so let's talk moral hazard and adverse selection. This is the way our banking system currently works. What is the moral hazard issue related to this concept, the situation? What's the moral hazard if we have FDIC insurance and these other government safety nets, lender of last resort and other things? So what is a moral hazard issue? You can think about it on the banking side, like does this cause the bank to be alter their behavior? So moral hazard post-contract or pre-contract? Post-contract. So now that we have this in place, does this cause the bank to, behave differently, or depositors to maybe behave differently or whatever? Daniel?
Does the bank get out more loans with people's money? Sure.
Yeah, I think they'd be a little more aggressive for sure, right? Okay, good. Did you have anything to add, Isaac? Is that what you were thinking?
Bank would probably, not risky, but.
So if you're a depositor, like even this person that we had here, but imagine we didn't have FDIC insurance, and you're looking to put your hard-earned $10,000 in a bank. What would you do differently if there was no FDIC insurance, and you just had $10,000 to put in a bank? What would you do as a depositor? Make sure you put it in the right bank. So all of a sudden, would you be looking at their balance sheet or financial statements, or at least reviews online or something, and you had other smart people that are calling some of the fraud or other things that are going on with this particular bank, right? So you would be doing banking more similar to you going out to eat, right? You would kind of be looking for a trustworthy bank, especially when it's $10,000, let alone a $50 meal somewhere that you go out to a restaurant, right? So you're going to be kind of actively kind of keeping bankers a little bit more honest. And so instead what we have is the government attempting to keep the bankers honest, right? The government is taking our place in a sense of monitoring and hoping that the government figures it out better and keeps them in track. So that may or may not be the case, as we'll see as we work through some of this content, whether that is a good idea. So definitely depositors here, depositors do not impose market discipline. Market discipline on the bank. What would be market discipline under the scenario of a free market where there was no FDIC insurance? What do I mean by market discipline?
They were closed.
What's that?
They were closed.
I don't know if we have to jump. I don't want to jump too far to the conclusion that they might close. But what would you do as a deposit? What's the discipline that the bank would feel if they had a 2-star rating versus a 4-star rating or something?
People aren't going to take their deposits there.
Okay, yeah, they're going to miss out on the deposits, right? That's market discipline. So it's like, oh gosh, Sally, CEO Sally at the bank, it looks like this month new deposits have fallen by 50%. I guess we did have that little scandal that went out, right? And so now, what are we going to do to build trust back up with our new depositors, right? Maybe it's a new marketing campaign. We change our management style, right? We're more customer focused, more customer friendly. Whatever it is, that's market discipline. That's not the government coming in and say, you got to keep these books in this kind of order. You got to disclose this to the people, and the people got to know, and there's got to be this and that and this. And so we got regulations this deep. It's just simply market discipline of them not showing up with their deposits. And now I have to correct myself to attract more deposits. That's the market discipline that's missing a lot when government gets involved in some of these types of situations. Okay, and then this one is kind of where I think Daniel was going. Financial institutions have an incentive to take on greater risk. So financial institutions have incentive to take on greater risk. They're not going to lose deposits, so if they start to make some loans to some shady characters, like we saw in that one video, then it doesn't matter as much, because the people are still coming in with their money, right? So I still have the money, but now I want to earn a higher rate of return at the margin anyway. We can take on a little more risk because our customers, the depositors, aren't looking for that anyway. All right, questions or comments on moral hazard there? All right, adverse selection. Adverse selection issue. So now, adverse selection is pre-contract. So if the government, if we have bankers trying to run, if we don't have FDIC insurance, then maybe we like the banking setup because we can take on more risk, right? So it attracts risk lovers, which we may not want in the industry. So risk lovers find banking more attractive. Risk lovers, which there's not really many risk lovers. We won't go into the technical details of that. So risk lovers find banking attractive. And maybe through setting up institutions, rules or regulations, or otherwise, maybe we can keep some of these people from getting into the easy money. And then oh, that's just nice. Never mind. I'm not going to put that one down. Yeah, I already talked about that. Okay. So, who are we attracting to our business depending on if the government's working to their favor or not? We might attract people that are not what we're looking for. Okay. Let's see. Let's do this one here. So bank examiners bring camels to audit. That's a little known fact that they actually bring camels, and they have to, for the United States, we don't have camels around everywhere, so it's a bit difficult how they pull that off, but when the bank gets audited, they actually bring camels. You don't believe that? All right, so what is McCullough up to here? So CAMELS is a acronym that helps us see what the bank examiners are doing. So the CAMELS, the C rather, is capital adequacy. All right, so in the banking stuff, back from money and banking a little bit, we touched on it maybe a little bit here, but what was the capital part of the equation for the bank. Daniel?
The required reserves?
Part of it can be. JC? Okay, so if we do the old equation of assets, balance sheet, assets minus liabilities, that leaves us the difference of, what do we call that difference? The equity. So that is kind of the capital side of the owner's equity in it. How much skin does the banker have in the game? So if assets equal liabilities, they might have some great looking assets, but they've got some big liabilities, and the liabilities might all be paying off, the economy's doing good, right? But they basically have leveraged themselves out. They've taken on way too many loans, and they don't have anything left kind of in the game, so to speak. So capital adequacy looks at how much is that owner's equity, how much do they actually have in terms of skin in the game. Okay, so that's the capital part. So you can put, let's just put equity, owner's equity, assets minus liabilities. So the A for camels is asset quality. Asset quality. That one kind of speaks for itself. What kind of loan? What is an asset for a bank? What's the biggest asset on the asset side?
Cash.
Not cash.
Loans.
Loans, right? So for a bank, when we have our banker hat on, the loan is the asset. Well, what losers did you loan money out to? You got, 90% winners, good solid people, and 10% losers, or are you at 60% good, upstanding, looking potential to pay back their loans, and 40% losers, right? So what is the quality of the asset? We can kind of dig into the their income of the borrowers, look at how solid they are, right? That sort of thing. All right, so that's asset quality. Management is the M. Management. How long has the team been in place? The CEO and the vice presidents, have they been working together for 10 years? Is there evidence that they're doing okay? The systems, the number of employees that are there in different areas to monitor borrowers and doing paperwork, all that stuff. What is the management structure? Earnings is the E. So do we have pretty decent margins coming up in terms of the spread maybe? So what did we mean by the spread for earnings? Again, you have your banker hat on. How do we make money? Loans. And so how do we make money? More specifically, we're looking at overall net earnings. It's not just the loan amount coming in. Mortgage loans versus checkable deposits. So how do they actually make money then? We look at the income statement. They got interest. And then what's the difference between the loans and the depositor's interest? Yes. So that spread between what you're paying what your loans are paying, if it's on average 6%, and you're paying your depositors on average 2%, then you've got a 4% spread. Some of that spread, though, goes to pay for your overhead and management, right? So we're basically just looking at your overall earnings. How does that look like on a month-by-month basis? So earnings is more on the income statement, or sometimes called profit and loss statement. So this is per quarter, per month, per year, right? This is over a period of time. What do the earnings of the bank look like, or the institution? So we've got kind of the balance sheet up here with assets minus liabilities. We've got the income statement. We're kind of looking at this financially. We're also looking at it holistically with the type of management. The quality, asset quality doesn't always show up on a balance sheet, right? Or the income statement. You might have a risky loan that's bringing in 10% interest now, but is that going to happen next year, right? How risky, what's the quality? So you start to see it's more complex as we move through things. The L is liquidity. So with liquidity, so we got the general definition is what? Liquidity. Bryce, we haven't heard from you for a while. What? Bryce C.
Like how easily you can change it into a medium of exchange.
Yeah, into cash or yeah, exactly. So the more liquid you are, the more risky you are, the safer you are. More liquid, more risky, or less risky? Less risky, right? So liquidity. So on this, they might start to even look at how many 5-year loans do you have? How many 10-year loans do you have, right? So which one's more liquid, a 5-year loan or a 10-year loan?
3-year.
The shorter term, the 5-year, right? So you can come up with measurements of liquidity and the ability to cash out if there ends up being a problem that needs some cash. Do you have assets that you can turn into cash in fairly short order? All right, and then lastly is the S, and that is sensitivity. Sensitivity to market risk. Sensitivity to market risk. So we got some videos that we're going to look at, and one of them is going to explain a stress test to measure sensitivity. So they use a computer, they plug in all these details in different ways into a computer, and then they say, suppose we have a 10% downturn in the economy. Suppose we have a 10% withdrawal of deposits. What does your bank look like? If you're really fat on cash and fairly liquid, then a 10% downturn, you're like, oh, yeah, you're still in solid, you're still meeting minimum requirements of where your bank should be to be financially sound. But if a 10% turn causes you to go raise a red flag, then you're not going to score as high there. All right, so I think we'll do one more thing and then we'll hit this video. So after the Camels audit, oh, I forgot on this management one, I wanted to do a risk management reading. So they have a score of 1 to 5 of risk management. Rating. So basically the auditor will have some metrics and rubrics or whatever to give them a score of 1 to 5 on their management rating. All right, so after the Camels audit, the bank is put into a group, into a grouping, into a category, according to capitalization. Okay, group number one is you exceed the minimum capital requirement. Exceed minimum capital requirement. Number two, you are adequate. You adequately are capitalized. Number three, you are under capitalized. Which just means you failed to meet minimum. After the stress test, after all of these categories, everything's compiled. Number four, you are significantly undercapitalized. significantly under cap. And then number 5, you're in hot boiling water. You are at the critical stage. So when you're at the critical stage, you're going to start to get restrictions on whether you can do new loans. So this is going to prompt corrective action. You are out of compliance with federal guidelines, and if you keep this up, you're not going to be a bank anymore. We're going to take away your charter, and you're gone. Okay, so any questions there? All right, a couple different videos here. Let's see, we should start with this one. I'm gonna have to cut and paste so we can find it. Hope they didn't take it away. This is a really good one. Unless it's just a date. Yep, this is it. Okay, I just have to.
I intend to zoom in on the main.
Okay, so take a few notes down. Ask me. I want everybody to have one question for me or comment on this. So we'll have a short discussion, but this will make it. This is a good video to kind of get you flowing on this.
Jack seat of this new regulation, and on the main changes Basel III will bring to banks.
Basel.
Let's start with the first one. Basel III, as the name indicates, continues on from Basel II. Basel II was mainly focused on the level of capital. When lending money, banks engage in activities bearing some level of risk. For this, Basel II presupposes that some risks come with lending, and part of the capital has to be set aside to cover these risks. To illustrate this, we will take BNP Paribas Fortis as an example, using some round numbers to render the comparison somewhat easy. Let's use 200 billion of loans as the starting point. Basel II states that some risks are associated with those loans, and Basel III continues this reasoning. This risk is not equal to all of those loans. For this, the loans are weighted in order to arrive at the total amount of risk-weighted assets. Returning to the 200 billion of loans, some are weighted at 100%, some at 50% or less. In this instance, 200 billion of loans give us 100 billion of risk-weighted assets. Basel II told banks to set aside 2.5% on the risk-weighted assets, or 2.5 billion in this case. Basel III is using the same concepts, but imposes not 2.5%, but 7%, or even more, depending on the nature of the activities and the type of bank. This was the first axis, leading to a considerable increase in the required capital for banks. The second element Basel III adds relates to the size of the balance sheet. In past years, we have seen balance sheets of banks growing significantly. Basel III insists on limiting this and even stimulates banks to take initiatives to reduce them. The way to impose this is by putting a limit on the size of the activities a bank can develop compared to its own capital. For this, a leverage ratio has been developed. The third element added by Basel III, and probably the most important one, is liquidity. Liquidity is represented by this bucket. The bucket is not filled up with water, but it represents liquidity, so it contains euros and cents. What is liquidity to a bank? A bank receives deposits and grants loans. Every day, the bank disposes of a certain level of cash through its activity of collecting deposits and by providing cash to clients while granting loans. It's very likely the bank will not be in equilibrium at the end of the day. If it has more deposits than loans, it will deposit part of them with another bank. If it has granted more loans than it received deposits, it will go for a loan with another bank via the so-called interbanking market. Of course, it's key for a bank to have equilibrium between its loans and deposits for each period of time. To be sure such equilibrium will exist, Basel III has developed a specific regulation. Before zooming in on this, I will first explain the metaphor of the bucket used in this film. As we saw, the bucket fills up with euros and cents. So each time the bank receives a deposit, the bucket will fill up. Each time the bank grants a loan, some liquidity will leave the bucket. Why? Because the related cash will be with the corporate client, the individual, or with the person who sold a good to this individual. Still, another aspect requires an explanation before we can tackle the regulation itself. The in- and outgoing cash flows are very typical to each bank. I can explain this as follows. A savings bank is specialized in the collection of deposits. Its bucket will fill up at high speed and can even have an overflow. At the other end of the spectrum, a merchant bank specialized in lending activities to large corporates will see its buckets emptied at high speed. It's mainly the speed of the bucket filling up and emptying that is typical for each bank. For this, Basel III imposes standardized stress tests on all banks. In fact, Basel III compels banks to have sufficient liquidity available during a period of 30 days of stressed conditions. In normal conditions, one can expect a loan to be reimbursed completely at its maturity date. This is not the case during the stress test window of 30 days. Then only 50% serves to reimburse the bank, and the bank has to inject the other 50% in the economy by granting new loans. So for loans at maturity, 50% leaves the bank again. Let's have a look at the treatment of deposits. The first category is deposits from individuals and from small and medium-sized companies. Basel III states they leave the bank at 5% or 10%. So during the 30-day stress period, 5 or 10% of those deposits will basically walk out the door. For deposits received from banks, the runoff percentage is at 100%, meaning they will leave completely before the end of the stress test. Of course, a third category exists, the one relating to deposits from corporates. Here, a very important notion is introduced by Basel III. 25% or 75% of the deposits of corporates will leave, depending on the existence or non-existence of an operational relationship between the bank and the corporate. In other words, if a bank has 10 billion corporate deposits and an operational relationship with these clients, 2.5 billion will be lost. Suppose no operational relationship exists. The bank might even lose 7.5 billion of these deposits. The result is a 5 billion difference in the stress test for Basel III. We'll come back on this Basel III tendency to guide banks towards more traditional activities.
What did that operational relationship mean to you? I don't expect y'all to pick up on that. operational relationship between a company and a bank. Jacob?
Unlike the small stores here, they're more affiliated to the bank than like a big corporation that goes in and they don't really have much to.
Can be, you're kind of touching on the right idea, Eddie.
The bank wants you to do good, so you'll pay back your loan. You want to do good, so you can pay back your loan.
Well, it's actually deeper than that. It's more of the accounts that you have under this circumstance here. Bryce, S?
Maybe like they give you like a better interest rate or something on the loan.
No, not under this context. So this context was kind of particular. Remember, the auditors are coming in, auditing the bank, and they want to know, like, if kind of the crap hits the fan, how much is going to leave your bank? Well, if you have an operational relationship, you might have multiple accounts if you're a big corporation. And so are all of those accounts being held with the bank or not? So the bank might have even a requirement. We're going to give you this loan, but we want all of your accounts, right? And so now, if the money moves from one account to another account in another division or a different state or something, the money actually never leaves the bank, right? So we're thinking about the leakage of money out the bank. So that's kind of the context that they need here. Any other comments or questions so far?
Explain that at all times, enough liquidity has to be available to comply with the stress test. This will put pressure on the net results. Remember also that the required increase in the capital must be set aside. So we are dividing something becoming smaller by something becoming larger. This leads to a reduction in return on equity for banks. This is a very tangible Basel III impact on banks. The primary challenge to a bank is the managing of the equilibrium between loans and deposits. This is a fundamental daily challenge that will drive the banks. As I have explained, banks face a profitability challenge. Revenues from cross-selling will be welcome, and on top of this, cross-selling will be required to manage the equilibrium loans deposits. However, this cross-selling also leads to more operational intimacy, the kind of operational relationship we referred to earlier. So, while managing the balance between deposits and loans, cross-selling will also be key. The operational intimacy this will bring will help to retain the required liquidity levels for the stress test. So, this is very fundamental to the required calculations for Basel III, as well as for the continuity of the bank. This leads us to our statement that banks have to have complementary activities to the business of granting loans and collecting deposits. Cash management is a good example. Cash management is key in this context. Factoring is also a complementary activity. The former Fortis factoring entity has now returned to BNP Paribas Fortis to become part of the service offered to our clients. With what you have just seen, I hope I've provided you with an overview of what Basel III is all about, how it impacts banks and the shifts it will bring to the interaction with their clients. This means that banks will work on a closer relationship with their clients and put more emphasis on traditional banking activities. Thank you all for your attention.
All right, that was the push after the financial crisis. He kind of wrapped it up with those operations and stuff. Who remembers some of the ratios from Foundations of Finance or accounting class? Return on equity, what's that equation?
Net assets over equity?
Okay, this one?
Yes.
All right, so we've got, in terms of a bank, the equity is the bank's capital, like we were talking about a bank's capital requirement, right? And then the return on your capital, what did you say it was upstairs?
Net assets.
The assets, no. Not for the return.
Net profit.
Net profit. So we're looking more at some measure of profit. Like, I just made $100,000. Well, how much did you have at stake, right? So the return on equity. So this was, in the video there, they kind of said results or, return, but that would be more of the flow from the income statement. So this would be kind of bank profit of some measure. And then the leverage ratio is the bank's capital over the total assets, yes. And so again, what is the bank's assets? In general, what's their big assets? The loans, right? So it's kind of like we're taking how much capital do you have versus the loans you have out. So if you've got $10 million of loans and $1 million worth of bank capital, you're at a 10% leverage ratio. Like how far out are you on these loans? Okay, questions or comments there? Got another short video to wrap up class today.
But then don't look at the bank.
Just banks so over time, sometimes banks specialize in different things. And so those were like possibly short-term loans to businesses. Merchants are just small businesses on Ottawa Main Street possibly, or something like that. All right, let's hit this one. This is kind of a fun one.
Faced with many challenges and pressures to succeed, you need to find a comprehensive solution. Whether you're a financial analyst, community banker, officer at a large bank, or treasurer at a corporation or municipality, you're very interested in the safety and security of selected banks. Now there's a tool that quickly sifts through and analyzes the data banks provide to regulators. It's TDS Bank Monitor, a robust online service, complete with mobile apps, that lets you create the tools you need to measure risk at FDIC institutions, bank holding companies, credit unions, even international banks. Its flexibility and ease of use is unparalleled. Use the search tool to set up a watch list. Develop custom analyses using numeric computations or logic algorithms. Conduct peer group analyses going back to 1995 and design and build customized scoring systems. The system's wide range of reports include the Bank Monitor Stress Index, Counterparty Quality Score, Capital Adequacy, as well as the Bank Monitor Shadow Camels, including those weighted for FDIC CFR Deposit Assessment Risk Category computations, and so much more. No other single product provides the range of data and analysis that TDS Bank Monitor does, and trained personnel are available to advise clients. Get the best bank surveillance and risk analysis tool available. Contact TDS Bank Monitor today.
Imagine if we had that as an app, these could be private alternatives to government monitoring. So that's why I kind of like that one. That was actually a tool that's probably for big investors to analyze banks if they're thinking of investing. But I thought that thing is certainly more and more relevant today with all the apps. All right, we'll call it a day. See you tomorrow.